Thank you very much indeed for joining us. We were going to talk a little bit more generally about what's happening in the Europe, but I need to get some reaction from this. The UBS seems to be saying this is some sort of unauthorized trade. That must be what every investment bank around the world must fear the most, and one would have thought there may have been strategies in place to make sure those didn't happen.
You would have hoped so, yes, certainly. I mean, I haven't seen the details. It certainly won't help the public image of investment banks generally at a time when obviously they're not in the most favourable light with many people out there. But in a time of sort of greater regulation and Basel III, etc., it will sort of raise questions about regulatory capital and whether we're positioned and against whether the regulations and the ring fencing is there for avoiding these sort of issues.
You are senior credit strategist. I'm wondering whether this sort of thing might actually impact the way UBS can actually access the funding market.
I think the market generally for financials and funding has become much tighter over the last couple of months, and it certainly won't be eased by these sort of headlines. You've seen the OIS Euribor spread sort of peak out at levels we last saw in March 2009. This will only contribute, I guess, to that sort of reluctance to lend overnight. And the issues, and you'll hear headlines about counterparty credit risk starting to rise even more acutely than they have done of late. This really just is another contributing factor to a very nervous and fragile credit market more broadly.
We are 3 years to the day since Lehman filed for bankruptcy. Are we seeing the same sort of issues that we saw quite soon after that banks stopping lending to each other, they're just not trusting each other? When you get something like this that we've just heard from UBS, that ain't going to help.
It's not going to help. I think we're in a very different position today than we were, say, 3 years ago. 3 years ago, with Lehman, it was very much about a banking crisis. Today, we're looking at sort of a macroeconomic, a global issue in terms of debt in the US as well as within the European sort of sovereign space. So we're in a very different predicament today, a much more severe predicament, I'd argue, possibly today than we were 3 years ago. But certainly, all these different headlines wouldn't convince me to start rushing back into the market and investing sort of across the broad spectrum of risk assets until we get some clearer degree of clarity.
Why do you think we're in a more severe sense of climate, as you just put it? Is it because actually the institutions that we've relied on thus far are just running out of armoury?
They're running out of armoury.
And money.
And money. Well, that was exactly the same. But, 3 years ago, it was Lehman. It was about the financial system. We were trying to price in systemic risk in the end of the financial system as we knew it. Today, we're effectively could be pricing in the end of, the Eurozone, albeit that wouldn't be sort of my base case scenario. But, that is the things that people are now discussing. They're talking about a global economic slowdown. We're already in recession, still in recession in, many parts of sort of the Western world. It affects all walks of life. It affects all walks of the market. It's not just about banks, it's about industry. It's a much more sort of far-reaching scenario that we're facing today than we were then.
And how concerned are you about the outflow of capital away from Europe?
I think, going forward, one of the areas of strength that we've seen over the last, several quarters has been the emerging markets. And I think, the longer we take or procrastinate about, how we go about dealing with Greece and the periphery, or the inability of the, the European elite to do that, then, the bigger the risk that capital starts to see its way out of Europe and going elsewhere.
You see the yields on the safer, so-called safe havens, whether it's US Treasuries or gilts, really yielding virtually nothing. Isn't it time maybe to take a look at more speculative grades and take that risk a little bit further?
I think you probably have to take a combination of the two, because for the investors that I speak to sort of day in, day out, it's cash, it's capital preservation, which are sort of at the forefront of their investment strategies for the time being. Nobody knows quite how bad things could get. It's cash and capital preservation are key, but at the same time, as you say, with interest rates where they are and as low as they are, you want to get some form of return. You do have to stretch down, but it's got to be very much sort of on a name-by-name basis rather than going anywhere more broadly.
Simon Ballard, thank you very much indeed.
Thank you.